Lee, thank you so much for joining us. So just coming off of Jay Powell's testimony in front of Congress today, speaking, fairly positively about the economy, but saying that he's seeing some conflicting signals out there. How should stock market investors be reading his comments today?
Well, I have an overriding. First of all, in terms of the Fed, they're going to be data dependent. If the data supports a rise, they'll increase rates. If data doesn't, they won't. And my guess is they're on hold for the foreseeable future. Maybe get something happening by December, depending upon how the economy unfolds. But I read him as being very practical, very pragmatic, and he's going to just wait to see what the data suggests. I think on a bigger picture, we're in a very abnormal world, and I think investors have to recognize that. The reason I say we're in an abnormal world is there's somewhere, depending upon whether it's Bloomberg or JP Morgan, somewhere between $9 and $11 trillion of sovereign debt has a negative interest rate. Just think about it. You lend money to Germany for 2 years, you get negative return. You lend money to Germany for 10 years, maybe you get 10 basis points. You lend money to Japan for 10 years, you get 0. Okay, it's not a real world. So I, as an investor, try to figure out what's normal. Okay, to me, what's normal, I've said this repeatedly, it's old news, is the labor force grows in America about 0.5% a year. The productivity of the labor force grows 1.5%. Labor force growth and productivity growth determine real growth, so that's 2% real. And we're probably slowing to that kind of level right now. And the inflation that we're looking for is 2%, so call that 4% nominal. In a 4% nominal world, the 10-year government bond ought to be 4%, not 2.6. It may take several years to get there because of global interest rates. And the Fed funds rate ought to be something like 3%, currently 2.25. In that world, I think the S&P ought to trade between 16 and 17 times earnings. And S&P earnings we're using this year of 170. So if I put a 16 to 17 multiple on 170, you come up with a market that's somewhere around fair value.
So you think the market currently is trading at fair value?
Yeah, it's fair value, but important to me, the S&P might be fair value. I can find a lot of stocks that are attractive relative to their fair value. And importantly, the conditions that would normally lead to a big market decline just don't seem to be present. What are the conditions that lead to a big market decline? Number one is the stock market smells an oncoming recession. Recession isn't in the cards. Economic slowdown, yes, but recession isn't in the cards. Second, a hostile Fed. The Fed is far, far away from anything hostile. Interest rates adjusted for inflation are 0. Normally you have 400 or 500 basis point real rates before you bring the stock market and the economy down. Okay, thirdly is speculative valuation. We don't have speculative valuation, and we don't have the public, operating in a speculative fashion. The fourth thing, which you can't forecast, is some kind of significant geopolitical event that just happens out of the blue, and lots to worry about. North Korea, Ukraine, you name it. The White House, we have an unconventional White House, which is destabilizing people a little bit. But I think the conditions of a big decline aren't present. The market is in a zone of fair value. We're okay.